GURU, sorry, on the TSX. I have with me Carl Goyette, CEO of the company. So, Carl, let's start with just the elevator pitch. What's the company about? Just an overview of the products.
All right. Thanks for the invitation. Good evening, everyone. It's great to be here. So the short story for Guru is unfortunately the slide doesn't come out too great, but we make organic energy drinks, so better for you energy drinks with a very short list of organic, better for you ingredients instead of a long list of artificial ingredients like our competitors. So it's the healthy, better for you energy drink made with some of the natural plants that you can probably barely see at the bottom there, but for functionality, we use ingredients like green tea, guarana, echinacea, yerba mate, and we never use any artificial sweeteners. So there is a sweet taste in the product, but it usually comes from natural plants like stevia, monk fruit, inulin fiber, all natural ingredients. That's the really short story on what we do. Obviously, a very different product. We'll speak a little bit more about a very different brand later on as well.
Yeah, perfect. I'm sure many of you are already familiar with the brand since it's so well known in Quebec. Carl, tell us more about your background. How did you get involved with Guru?
Well, I come from an entrepreneurial background. I studied I pretty much since I was a kid, I thought I was going to become an entrepreneur. So I went to business schools. For the people from Montreal, I went to HEC, and I was a fan of Guru since day one. I'm not the founder. I joined Guru much later on. Guru was founded when I was still in business school, but I was drinking the product since day one. I was a big fan. Funny story on this is I got married in 2002, right? So that's almost 12 years before I joined Guru, and the featured drink at my wedding was vodka Guru for the ones in Montreal. So it was like a little bit coming full circle after when I joined Guru. So I was a big fan drinking the product. I used to have this routine where whenever I would have an important meeting, I would go and grab a Guru before the meeting. Otherwise, I thought I wouldn't have a great meeting. Anyway, I had a career in consumer packaged goods, different organizations through the years in sales, marketing, pricing strategy. I met Ingy there, where CFO is in the room. So we worked together in other companies. And after 15 years in big corporations, I really wanted to get back to a more of an entrepreneurial experience. And I was looking to acquire a company and came across Guru, which at the time was managing $4 billion in sales in the large organizations. And Guru at the time was $5 million in sales. I thought was really small, but I was a big believer in the potential. So I made a big move. Fortunately, my wife agreed to remortgage our house, and basically we were lucky enough to have paid our house, so remortgage, and went all in and bought out two of the founders that had founded Guru. So myself and my wife pretty much invested significantly to become one of the three partners. So we were all in, and this needed to work, but I was always a big believer in the potential.
That's a bold move. I love that.
Yeah, all in.
Yeah, exactly. Okay, can you talk a little bit about the industry more broadly, and how did Guru position itself in the industry? You already touched on it a little bit, but also maybe some of the recent trends in the industry and how you adapt as well.
Well, the industry I think, is a fantastic industry that has a big problem, right? It has a big problem because it has a bad reputation because of the mainstream, the big players using artificial ingredients. But this industry is thriving. Just coming in, walking in here, I had new industry reports. The industry is at $25 billion in North America, growing almost 15% in the last 12 weeks, right? So even though it's really big, it's still growing very fast, very profitable. I know this is a microcap conference, but if you want to have an inspiring story around investments, if you look at brands like Monster and Celsius, I'm not inspired by their ingredients, but if you look at their stock performance over the last decades, it's been quite impressive. So the space is very big. It's still growing, great margins. But most brands, unfortunately, it doesn't come across, but most big brands, the two main brands in the industry are Monster and Red Bull. They have similar ingredients, similar marketing around, I call it teenage boy marketing. It's the NASCAR, the motocross, extreme sports. Nothing against that, to be honest. It's worked wonders for the industry. But we do something that's very different, right? We target the healthy, active lifestyle consumer, the people who run, cycle, live a healthy lifestyle, who are not interested in that type of lifestyle, right? So we target a more professional, educated consumer, typically more in urban areas, who don't shop in the same way. Right? They tend to shop more online. They tend to shop more in grocery versus convenience. But so we not only offer a very different product, we offer a very different brand. Because in this industry, marketing, the positioning, the lifestyle brand, the lifestyle aspect of the brand is critical. Now, having a great product is not enough to win, but you really have to have a great brand. It's a little bit like in fashion.
Yeah.
It's a product. In marketing lingo, we call this self-expressive benefits, but it says a lot about you. Right? The energy drink you carry with you says a lot about you. A little bit like fashion and watches and sneakers and things like that, right?
Interesting. Okay, let's dive into some of the numbers. You published financial results last week. Your stock has been on fire since. Congrats.
Thank you.
So, revenue growth was 31%, first ever profitable quarter as a public company. What were the key drivers of this performance?
I think it's this, like to us, to NG and I, there was no new news in this because we've been telling the same story for quite a while. I think it's very important to mention that we announced our first profitable quarter as a public company, but we were profitable for 20 years before going public, right? So NG and I were there before the company became public. We knew we could always make a profit. When we went public, the whole thesis was we're going to raise cash and we're going to invest this. And we told all investors that we could be losing money for a while because we'd be going aggressively for growth. So we started spending a lot more. And to be honest, when you spend more, you're not as efficient, right? We learned somewhat the hard way that sometimes spending well is not easy. So we made some mistakes along the way, but we learned a lot through that journey, right? So we spent aggressively for a few years. We kept telling everybody that, hey, we were profitable in the past. We're going to get back to profitability. Somehow, the investor community did not believe it until they saw it. And that's probably what happened last week. But we could model this easily that, with the margins we make at 65% margin, it's much easier to break even if you reduce your spend in sales and in marketing, right? So we know we can turn the dial on marketing and sales to adjust on profitability. I think the future is going to be about modulating growth and profitability because clearly investors like the profitability.
We want both.
Well, everybody wants both. But there was a time where investors wanted more growth for sure. It seems like investors want more profitability. Honestly, I don't manage this for the stock price. We manage this because we're on a mission to clean up this industry, and we think this industry is going to drastically change over the next decade. I can't believe that in 10 years, everybody's going to still be drinking Monster and Red Bull. There is better options out there, and I think this is an industry that's ripe for disruption. So we're going to be transforming this industry. We're going to do it the right way. If it means losing a little bit of money because we have an outstanding opportunity that we want to attack, we're going to lose a little bit of money on one quarter. And then maybe on another quarter, we're going to be profitable. We still have $25 million in cash that we plan to invest in this business, right? We're not going to let that money necessarily sit in the bank forever. That's why we raised that equity. But I think our commitment is it's to balance growth and profitability, knowing that most investors want both, right?
Yeah, makes sense. And if we look a little bit, below the headlines, what's driving this growth? Is it more like in the US and Canada? Is it more online or physical retail? Like, what can you tell us on that?
Well, this quarter was driven by a lot of growth in Canada. Right? The growth in Canada was around 35%. Growth in the US was slower than in the past quarters. The main reason for slower growth in the US this quarter was, if you're following this space, you may have heard that there was a cyber attack on a very large distributor in the US. They're called UNFI. So it slowed us down for a few months. This is going to correct itself in the future. So it impacted a little bit of US, but both countries were growing. Obviously, if you look at long-term potential for this business, most of the $25 billion industry that I spoke about is in the US. So obviously, in the future, we expect more growth to come from the US. Online, we don't disclose the exact numbers, but we did disclose that we were up 90% on Amazon in July and on Amazon in the US and 40% in Canada. So there is tremendous momentum for better for you energy drinks on Amazon. And some of you might be thinking, well, Amazon, who buys energy drinks on Amazon, right? The reality is Amazon in the US, the size of the energy drink industry on Amazon in the US is as big as all of Canada, all channels combined, right? So it's above $500 million in sales of energy drinks on Amazon in the US. So you can imagine the potential for this. So it's already a significant part of our business. We've been betting on this since 2005. So we've grown a very solid baseline, but we intend to keep investing because this is where our consumer shops. The consumers who are looking for better for you products, they know they can't necessarily find this in convenience stores. They know they can't necessarily find this on every corner. So they become a little bit more savvy about where they can find these products, and they buy in bulk on Amazon, and they're totally fine with that. So there's huge potential for us.
Okay, perfect. What can you tell us about the change in the distribution strategy in Canada? You know, you used to do direct distribution, then went with PepsiCo, then back to direct distribution. So walk us through this whole process and maybe the pros and cons of each model.
Well, this could be a long one. For the people who are familiar with this space, I think there's two main routes for the market. There's one that's called direct to warehouse. So basically, you are selling to Metro, Loblaws, Couche-Tard. You're selling directly to those retailers. And there's another route, which is a direct to store delivery model. So you're using a large distributor to sell directly to stores. So for the first 20 years of our company, when we were always profitable, we were in a direct to warehouse model. And there is a common wisdom in the beverage industry that when you make it, you either end up, at some point, you end up on the blue trucks or the red trucks, right? So the blue trucks are the PepsiCo trucks and the red trucks are the Coke trucks. They're the two largest distributors in Canada. In fact, they're the only two nationwide DSD distributors in Canada. There are more options in the US, but in Canada, they're the only two. So after going public, there was an opportunity to get on the blue trucks. We tried that. There was some benefits of that. It generated a lot of volume. We traded off a lot of margins in between. And for all sorts of reasons, we never became a full priority for the blue system. And we agreed that it was because of conflicting priorities and different brands and stuff, we decided to go back to our previous model that served us so well for 20 years, which explains a big portion of the big gross margin bump that you saw in the last quarter. In the DSD system, we were giving away a lot of margins for service, right? So we were more in the 53, 55, 56% range. Now we gained back 10% gross margin, which obviously helped a lot with the profitability. So there's pros and cons to both models. Some people are big believers in DSD. I think I would end this question with saying that with everything that's happening with AI, the increased sophistication of the warehouse model, if I give you an example for Quebec banner like IGA, they're becoming extremely sophisticated, right? There's a Sobeys truck that goes to the store every day pretty much. They have automated reordering, AI forecasting. They know in every store how many cans they sell every day. So there's not that much of an advantage to DSD anymore. DSD being a direct-to-store delivery.
Is it harder to scale when you do direct distribution, or there's no impact on the ability to grow revenue and scale nationally?
No, it's not a difference. It's just two different models. I think both like big brands have scaled in a warehouse model. Other brands have scaled in a DSD. Most of the very, very large brands, like the PepsiCo and the Pepsi and Coke, is in the DSD model. But if you look at emerging brands, they're not necessarily going into DSD.
Yeah.
The US is a very different market, but in Canada, no.
Okay, I want to touch on innovation. It's one thing I like, especially recently. I mean, you've shown your willingness to develop new flavors, put out new products. You have your zero sugar line now that I think is getting more and more popular. So, can you talk about that? What's been driving this innovation?
So that's just listening to our consumers and looking at industry trends. This is an industry that is not changing only to become more towards better for you, but just consumer preferences are just changing. Consumers want innovation. This was just 10 years ago. If you looked at Red Bull did 90% of their sales with Red Bull Original and Red Bull Sugar Free, and Monster was pretty much the same. Consumers want more choices, and that's not only an energy drink. If you look at the variety of beers, if you look at most industries, there's more choices. So we got on this over the last few years. We innovated with the punch lines that have different functionalities for focus. We were working really, really hard to develop a zero sugar product. It took us a long time to do this because zero sugar products are very easy to make with sucralose and aspartame, but there are artificial ingredients that we never want to use. So it took us more time. The science evolved. There was new innovations in sweeteners that allowed us to create a great tasting zero sugar product. And that's really taking on. If you think about our consumer who's educated, healthy, active, taking care of their health, they don't want to consume calories in their drinks. So the launch of this zero sugar line over the last year, over the course of the last 12 months is driving a lot of the growth that we're seeing.
Okay. I have a couple more questions, but maybe we can open it up if there's anyone. Yeah, go ahead.
I have a question. So I love where we are. Like for your site, I think it's.
Thank you.
I think I was shareholder many years ago, a couple 3-4 years ago. How do you become $100 million company? You got Pepsi. I think it was Pepsi partnership. Like, what's the problem with the rest of Canada and USA that just doesn't realize it's a better product? I've tried Celsius, it's garbage. Monster tastes good, but it is garbage. I find like Blue Roots, you have a steady energy. I have friends who drink 3 porn a day, knowing they feel okay, and they're used to it, right? Because you can increase your caffeine intake slowly, right, and be okay. So like it's an image thing, right? It's clearly an image thing, right? Yes. Americans should drink Blue, not Celsius. Celsius is garbage, It's and you're sold in the same spot. So what's the 5-year? How do you get Blue to be on every state in the US, or in West Canada?
Okay, I'll just read the question for the recording. So basically, you said Celsius is garbage.
I didn't say that.
No, so basically, you're asking how do you scale this business to 100 million plus in revenue, and how do you get consumers to realize that this is a better for you product, better than everything that's out there in the market?
Yeah. So ultimately, the short answer to this would be the best product always win. But in the end, I also agree with you. Earlier on in this presentation, as I said, having the best product is not enough to win in this industry. You also need to have a great brand. So a lot of our momentum is also going to be about making sure we understand the consumer. And we spent a lot of time over the last few years to really understand who the consumer for better for you energy drinks is today, because we think this consumer is going to change. There's going to be more of those. So not all energy drink consumers care about their health today. I can tell you that. There's a lot of people who don't care at all, right? Especially the people who, for some reason, buy in convenience stores. They're less educated. Some, like they couldn't care less about buying 2 drinks with 60 grams of sugar each, right? So before breakfast, they're down 120 grams of sugar. Unfortunately, that's still happening a lot in this industry. So we understand who the consumer is, and we're going to be super focused on that consumer from a brand perspective, but also where they shop. I spoke about Amazon, right? They tend to shop there. They shop in the natural channel. They shop in very premium grocery chains in the US. right? They're not necessarily the typical 7-Eleven consumer for now. I think they're going to become the 7-Eleven consumers, right? In a $25 billion industry, getting to the numbers you mentioned, you don't need to be in every single store, right? Once you're in every single store, you're more in the billion-dollar category, right? So it's about finding the right retailers, the right consumer.
Philippe?
Je peux le faire en français, ça va être dur, hein? En fait, je suis beaucoup de ça. Puis, moi, je m'intéresse beaucoup à ça. Je vais donner un exemple. Je pense aussi à la compétition de d'autres types de produits comme le Yablin Maté, c'était un jour de Burger qui est en compagnie de Maté, de Maté, etc. Puis, tu veux voir l'implication d'Engie, ça amène beaucoup de brand awareness autour du produit. Moi, je voulais savoir, à ce niveau-là, c'est quoi vos stratégies pour essayer de développer davantage de brand awareness, ces réseaux sociaux, pour justement faire découvrir ce produit qui est aussi bon et automatique, finalement, d'adapter vos stratégies dans le fond, de faire connaître le brand en ligne. Tu sais, tu as mentionné Amazon, je pense que c'est déjà un bon départ, mais je suis curieux dans la conversation.
Okay, so basically the question is, how do you develop more brand awareness online in a sea of potential alternatives that are out there and that are getting marketed to everybody?
Yeah, that's the $100 million question. So obviously we're not. This is probably the sensitive part on the marketing strategy that we don't disclose publicly, especially with recordings and stuff. But there's a little bit of art and there's a little bit of science to this. You mentioned celebrities. I think celebrity is one of many items in the marketing, many items in the marketing playbook. It's something that we've never tried. I'm not saying we're going to do a celebrity. I'm not saying we're not, but it's certainly an accelerator at the right moment. But it's a hit and miss, right? You mentioned one that seems to be working. I could mention 20 others that did not work at all. So you could give away a lot of equity in deals like this. The one you mentioned took over the company, right? So he's basically the owner. We're very different from, in our perspective, we're not trying to give away Guru to any sort of celebrity, right? So we're going to be managing this, but I think the point I would take away from this is great spokesperson, great ambassadors for the brand that are telling the right stories to the people, to the same consumer I was talking about, I think is probably one of the elements that we want to refine. There is a storyline in the marketing around good input equals good output, right? Meaning if you consume good energy, or if you consume good ingredients, you're going to have good energy. And there's a lot of ambassadors who can tell that story without necessarily being celebrities, right? So this whole idea around, is it micro-influencers, is it macro-influencers, or is it celebrities? I think that's up to the marketing team to decide what's going to be the best option.
We have time for one more. Yeah, go ahead.
So, you mentioned evolving consumer preferences, naming with respect to, for instance, the new brands released on Blue. In terms of thinking about that in the long run, are you looking at growing that in-house, or looking at opportunistic M&A perhaps to grow that brand, or to continue on innovation, maybe commenting on that?
Yeah.
Okay, so the question is, you plan to continue innovating or maybe acquire to continue to develop the brand over time?
Again, this is the type of thing where right now the strategy is, this is a pure play, better for you energy drink. We're focused on one brand and the brand is Guru, and we think that brand has a lot of potential, right? That's the short answer. The long answer was we're public. If ever there was the right opportunity to partner with the right brand that we could either migrate into Guru or make it a better brand, if it fits the right strategy, we wouldn't say no, but we haven't come across the right opportunity at this time.
That's all the time we have. Thank you very much.
Thank you, everyone.